Good morning. Why don't we go ahead and get started? I'm Kathy Clary, and I am part of the Gold Timers Committee. I'd like to start today by introducing the rest of the committee to you. We are all State Farm retirees, and I'd like you all to stand up if you are a part of the committee, please. We organize these meetings. We produce newsletters and reminder emails. We have a website we maintain. We set up the local tours and socials, and we work with our sponsors, Busey Bank and Direct Travel. I'm going to give you the names of all the individuals. Some of them are here today, but that's okay. Jeff Auberg, Linda Baird, Jim Ferrier, Joe Hack, Dave Kobus, Marie Litzenberg, Leanne Pesch, Keith Rich, Harry Rock, Greg Watson, Denise Wiedelsbach. And I did not miss anybody because I read my list. Oh, Denise just walked in. Tuesday was Veterans Day, and I was trying to decide what I wanted to say about Veterans Day. And I decided that I was simply going to mention that it's one day, it's a holiday that does not occur on a Monday, because somebody decided that November 11th was significant enough that we needed to keep it on November 11th. And I'd like to ask any of our veterans that are in the room right now to please stand up. Thank you all for your service. Now, don't sit down, Greg. I found out this morning that one of our committee, who is also a veteran, went on the most recent honor flight to Washington, D.C. And I thought I would give him the mic so that he could say a couple of words. And then Greg is also filling in for Direct Travel. Kimberly was unable to be here this morning, so he'll morph into that when he's done.
Thank you. I went on the flight a week ago, Tuesday. Now, you may have seen it on TV. They had a especially channel 20, I call 25. That's old school. I'm from Peoria. I guess it'd be WEK. That's the Peoria honor flight. We have two in the area, Peoria and also Springfield. Peoria is the greater Peoria honor flight. Springfield's the Land of Lincoln honor flight. And I'll real quick, it's a great experience. You have to have a escort with you, cannot be your wife. And the reason I've been told that it's not your wife is because when they first did it, they found that they had situations where the veteran was pushing his wife around in the wheelchair. So you have to have someone if you need a wheelchair. We had 70 veterans, 70 guardians, and then a lot of volunteers and some people from Hy-Vee because they sponsored it on the plane. Of the 70 veterans, 30 were in wheelchairs, which I don't know if that should surprise me or not. It did surprise me that many. So if any of you, I think it was one other veteran, I'm looking at him right now. If you've been on it, okay, it's great. And I would recommend the Greater Peoria one, the one I took. Because you go over to Peoria at the Paradise Hotel. They put you up at the hotel. You get a big banquet, and then they shuttle you to the airport. It's an all-day situation. You have to leave the hotel at 4:30. And one of the biggest surprises for me was when we arrived in Washington, D.C., we had people greeting us there, thanking us for our service. They didn't expect that. But we see all the sites, all the memorials. We missed out on Smithsonian because the government was shut down. That was the only downside of it. But weather was great. You get a shirt, which you can keep. You get a hat, or you can keep. I should have worn them today, but I do recommend it. It's the Greater Peoria honor flight. Just go online, an application. Your person that goes with you just has to be able to be in good shape too. So anyway, I will now take over for Kimberly. He gave me a script, so I'm going to read it. I'm not, first of all, we have a brand new group trip to Costa Rica. Departing November 20th to December 8th, 2026. The price is just $2,890 per person, which is one of the lowest I've seen we've had. It includes 14 meals and all excursions. The Douro River cruise in Portugal, we were able to get more seats on that, plus the price is lower. It's down to $5,899 per person. Keith, I don't know if you're going to get a refund on your price, but it hits it. You know, Douro in Portugal, you start in this, you go up, go through the river, and then turn around and come back. Now, for those that are into the total solar eclipse, I didn't know this. I guess you do put closer. I didn't know that, but there's going to be a total eclipse in Spain 2 straight years. In 2026, we've got a land tour from Barcelona to Madrid. And that total eclipse is only 1 minute, 44 seconds. The better one is actually one in 2027, where they're doing a Mediterranean cruise from Barcelona to Rome and on a smaller luxury ship. And that eclipse that's July 27th, August 6th, and that is 6 minutes and 8 seconds. The nice thing about a river cruise, or not river cruise, ocean cruise, is they can reposition the ship based on where the best view of the eclipse is. They've got, I think the rest of this, we've got brochures. What I recommend is, if you haven't already, pick out one of these. So with that, I think I turn it over to Britt.
Well, good morning. As always, appreciate being here. So thank you so much. Thank you to the committee, you all, ISU. Seems like this setting also too, just some general feedback, this setting's working out well. So again, appreciate the ability to do this here at ISU. Yeah, my name is Brett Peterson. I'm the market president. Again, I know almost everybody in this room. I'm market president for Busey here locally. Excited to have Derek down here today. But I want to give a few updates and then I'll read Derek in. And as always, it's always interesting. Always learn something when I listen to Derek. So again, some of the key resources that are available to this group in particular. So we do a retirement forecast and an investment analysis. This is a free service. The retirement forecast is a general look at your overall allocations, some cash flows, some stress testing on a portfolio. And it's a really good place to start if you haven't done anything like that in the past. We offer that. We also offer the investment analysis, which is a deep dive and a side-by-side comparison looking at what's in the portfolio, what the risk is, what your concentrations are, what the internal fees are. And again, using those two things, it gives you a pretty good idea of where you might stand. And again, those are both services that we provide to this group free of charge. Also, outside of these quarterly meetings that we help host or help sponsor, we are doing the workshops. Those are, our goal next year is to do 5 or 6. Again, I always like to get feedback on what those workshops from a financial perspective you might want to see, but we'll bring in partners and those are done through Zoom or WebEx and they're video, right? So you'll see those on the newsletter. The group does a great job of getting those out. The registrations are online. And so if you have any interest in those, please, feel free to join. And again, those are probably every other month or so. We also, another thing we don't talk about a lot is for this group in particular is we offer private banking to each of the Gold Timers members if you bank with us. And so what that is, that's a concierge service. There's some other promotional things that you get as far as account structure, account type, and that's run by Catherine Wills, who's in the back corner. I know many of you know Kat. So if you ever have any need or looking for a bank or need some help, we're there for you from that perspective. This meeting is being recorded, so this will be available online, hopefully in a couple of days. You can find that at goldtimers.org. That also too, you'll see our website too. We have a specific page called bc.com/goldtimers as well with some additional resources. With that, as always, I'm excited to introduce Derek Sasfeld. Derek's the Director of Investment Research and Strategy at Busey Wealth Management. Derek leads our investment research and strategy, focusing on disciplined asset allocation and thoughtful manager selection to create long-term value for clients. He brings extensive experience from leadership roles at multiple investment firms and is a graduate of the University of Illinois of Chicago, the University of Illinois and the University of Chicago. He is also a CFA chartered holder. Again, Derek, as always, thank you and looking forward to the presentation.
Okay.
So.
Yeah, I think so. Can you hear me on the lavalier? We're good. I like to use the lavalier because I might get frisky, but and I don't necessarily want to be stuck behind here, but we'll see how it goes. We were here a year ago, or a little bit less than a year ago, and the world looked a little different at that point in time. I think to some extent it's kind of like a Hollywood movie. We've sort of had a happy ending with markets, but the economy still has a lot of questions. I'm intending on talking about both the markets and economy. So I have a very creative title for my presentation, which is Economic and Market Outlook. That means I'm going to spend some time talking about consumers in the economy who have been surprisingly strong. We'll spend some time talking about artificial intelligence, or AI, because it's important to the economy, especially on the margin, right? Extra growth is coming from AI. And it's both driving extra growth in the economy, and it's clearly driving the stock market. So we'll talk about that and especially eventually the investment implications of that. We'll talk briefly about inflation and how much inflation we're likely to have. And then we'll talk very briefly about employment. And if there anything you want to ask about those categories in the economy, I'm happy to talk about them. We'll have some Q&A at the end. I always say that questions are fantastic. Heckling is not welcome, but questions are always good. So if you have something you want to say or ask about, that's totally fine in the body of the presentation, but we'll definitely have a dedicated area for questions at the end. And then I'll talk about stock markets, US and outside the US. Non-US markets actually are having a better year than US stock markets, which is surprising to some people, but we're global investors, so that's good. We'll talk a little bit about the bond market, and especially there was a question last year about mortgage rates. So we'll talk about mortgage and the housing market, which other than employment is really, those two are the weakest parts of the economy. And we'll talk a little bit about why that is. Then we'll talk about credit, or the areas of fixed income or bonds that are not treasury oriented. And then we'll close with a single slide on gold, because gold is the best performer of all investments this year. We can talk about the pros and cons of gold and maybe why that's happening. So if you have questions about gold, we can talk about that too. So let's get going. The U.S. economy has outperformed expectations. I'm sorry, this is a bit of a complicated chart, but the blue line represents the rate of growth of the U.S. economy. And, the expectation is for the coming quarter, so the third quarter of 2025 is expected to be just shy of 4% growth in GDP. That's higher than was expected earlier this year. So with all the tariff kerfuffle, that basically scared forecasters into building expectations where growth was going to be lower. And indeed, in the first quarter of this year, growth was lower. I've color-coded the drivers of economic growth, and you'll note that the gray areas, which are basically exports related to tariffs, and then changes in private inventories. So that's businesses building up inventories and spending them down around tariffs, clearly were meaningful. These gray bars are way bigger than they used to be in the first and second quarters of this year, and they added and subtracted kind of against each other, right? So they were additive and subtractive way more than usual. And I think we're through this largely. And so these won't be big contributors or detractors. But the most important parts are, as always, consumption in the dark blue, that's Busey blue. So that took a bit of a hiccup in the first quarter because people were concerned about tariffs. They read the headlines and they dialed back a little bit to be a little bit more cautious. But consumers are back with a vengeance. We'll talk about what's driving that. And the other thing is fixed investment spending, which is basically data centers. Okay. And that's AI infrastructure, which is responsible for half of this. And a third of it is being driven by just 5 companies doing investment spending, which we'll talk about. And they've been nicknamed the hyperscalers. So I don't just want to talk about AI because it's new or different or maybe fun, but because, this is a fun-free zone, right? So, we don't like to have too much fun, but AI is kind of fun, but it's a big driver. It's a massive driver of the economy on the margin in terms of extra growth, and it's also a big driver of the stock market. So let's take a look at consumers. You may recall personal income in the United States has grown by about 5% per year for the last 50 years, okay? And there are only a few interruptions to that. One was COVID, okay? So you remember that during COVID, in March of 2020, under the CARES Act, the government sent people checks, right? Most people saved a lot of that money. That's that first spike that you see there on the left-hand side in the green. The second spike was right before the new year in 2021, which was sort of the second tranche of checks that were sent individually to people from the government in income replacement. Then that third tall bar in green is the American Rescue Plan Act in February of 2021. That was almost as large as the original CARES Act payments to individuals. So most people saved a lot of that, okay? The green bars represent the savings rate in the US, or the savings amount in the US by savers, by households, net of what they typically would have saved. And for the last basically 4 years, people have been spending those accumulated savings, okay? Also, their incomes have been continuing to grow at about 5% per year on a nominal basis. So I think some of these red bars are less, they're smaller, that people were dipping into those accumulated or excess savings from the COVID period. And as a result, there still is by our estimate, about $400 billion of savings left over from COVID, okay? Most people have spent down their COVID savings, but the most wealthy and the highest income individuals still have some left, okay? And that's affecting consumption. It's affecting consumption in 2 ways. One is that, and some of you may have heard about this was research from Moody's Analytics that found that basically the top 10% of people by income are responsible for about half of the spending, the consumer spending in the United States, okay? So there's growing inequality in the United States, and that means that basically people who are in the higher end of the income and wealth distribution are responsible for the consumption, okay? Some of you may have heard, I just bought a new car and I made it under this number, so that's good. But the average new car in the United States costs $50,000, okay? So that tells you that there are a lot of people in the upper end of the income distribution spending a lot on new automobiles, for instance, right? They're driving that number up. And, housing has become less affordable and so on. But again, it depends who you are and what's driving that number. So when we look at the overall economy, there's the nickname that some economists call this is sort of a K-shaped economy. Some people are doing really well and some people are struggling. And we'll take a look at the struggling in a second. But in the aggregate, the other thing that's happening is that there's a massive wealth effect. So you may have heard that the US federal government has like a $38 billion debt, or trillion dollar debt, sorry, with a T, right? But household assets in the United States, household net worth is $176 trillion, okay? So that dwarfs that considerably. Now, I'm not advocating necessarily for a wealth tax, but the country is very wealthy and it is getting wealthier. You'll note that the dark line there, the black line there, and that's taken directly from the Federal Reserve website because they put out this data, has been growing considerably in recent years. And that's because of the equity market or the stock markets, also because generally of the performance of housing, especially upper end housing in the economy. So even though people are increasingly indebted, the liabilities are growing, the red part on the bottom of that chart, the assets have been growing considerably. And this wealth effect has also helped consumption. So consumption has been a lot stronger than I expected. I had thought that, this would run, the excess savings from COVID would run out sooner. They haven't, in part because incomes are growing, but also the wealth effect has helped a lot. Now, what we learned in the financial crisis is that if and when the stock market in particular falls in price, and the housing market also performed poorly during that period in 07, 08, 09, is that there can be a real economic impact from that. And there was a recession that kicked off in the wake of the financial crisis simply because the stock market fell and people felt poorer, okay? And these upper end consumers who have a lot of stock and own a lot of equities in the equity market may not always continue to spend if those prices fall. So, that's going to be an issue at some point for the future. It doesn't appear to be a big issue now, but we can talk about that. So consumers on the high end are still spending and appear to be fine. But if you're in the bottom, say, half of the income distribution, or maybe the bottom 2/3 of the income distribution, you are increasingly delinquent on some of your loans. So this is 90-day delinquency or 90+ day delinquency in auto loans, credit card loans, mortgages, home equity lines of credit or HELOC, and then student loans. So auto has risen and is at relatively high levels relative to its history. But in my view, not entirely alarming, but it is worth noting. Credit cards, close to where they were in the financial crisis period in terms of delinquencies, not rising at the moment, seem to have plateaued, but at elevated levels. Mortgages, not really worth worrying about at the moment. A lot of people have some affordable mortgages left over from when mortgages were 2.5% to 3%. Home equity lines of credit, same thing, but student loans are now off of forbearance. So in other words, those owned amounts now have to be paid again after going on hiatus for a number of years. And so you can see that that's also creating pressure, okay? And the fact that people are increasingly delinquent on some of their loans, especially the young, is influencing politics a little bit. And maybe we've seen some of that in the latest elections. One thing that people have done to deal with this is to get multiple jobs. Okay, so this is the percentage of the labor force on the right-hand side here of people who hold multiple jobs. And this is the result of survey data, okay? So the Bureau of Labor Statistics surveys people and asks them, how many jobs do you have? And this is probably an underestimate. Since COVID, people have been a lot less willing to answer surveys. Okay, so this is probably underreported a bit, but it's at the highest levels ever. So in response to this, structurally, the Bureau of Labor Statistics has said we're going to study the so-called gig economy and basically change our calculations and incorporate more people who are working in rideshare or other areas, side gigs, and having multiple jobs in the economy. And the economy has changed to some extent with regard to the jobs that are available to people as free agents in the economy and acting sort of as independent actors. So you don't necessarily have to work for a company. You can hang out your own shingle more easily these days than usual. So this is probably going to continue. It's probably underestimated. My understanding is that this is probably more like about 10 to 15% people holding multiple jobs. So again, if you're in the higher end of the income distribution and the wealth distribution, you've got stock, you've got real estate, you own assets, you're doing fine and you're spending. If you're in the lower end of the income distribution, you're trying to hold multiple jobs to make ends meet, okay? So this makes forecasting a little bit difficult, and it's not necessarily, I think, the economy we want, but it's the one that we have, and it's impacting investments in particular. And that's sort of what our mission here is, to talk about how to invest our portfolios. So that's consumers. Again, in aggregate, in the whole economy, consuming more than expected originally. Now, AI is, as I mentioned, a big deal. This is fixed investment spending for the Magnificent Seven. This includes AI and it includes other capital investment, but you can see some pretty well-known names right in this list. We've got Meta in green, Alphabet, which is so Meta's Facebook, Alphabet's the new name for Google, Amazon, and Microsoft. Those 5 companies basically are known as the hyperscalers. They're building data centers to provide processing power for AI. And this is about $100 billion a quarter. Okay, this is by quarter. So $100 billion of fixed investment per quarter. That means 400 billion a year. The economy is 30 trillion, so that's pretty big. But that 400 billion of annual run rate on data center and other infrastructure for AI is a significant contributor, right? And when you look at all the things that go into that and how that has to be done, it roughly works out to another 0.5% of growth in GDP just from that. So, and the reason they're called hyperscalers is because they're scaling these investments significantly. They also had a lot of capital, right? So they had a lot of cash on hand. They've generated earnings for a number of years. They had all those as retained earnings, and they were spending that down. But this is now being multiplied by, in essence, private debt and private equity managers. So part of my job at Busey is to select outside managers for things we don't do. That's in the public markets, but it's also in private markets. And I'd say about 1/3 of the private market opportunities that I see on a daily basis are infrastructure related for AI. Okay. So it's a bigger part than just these companies. But when you think about AI, there could be sort of 4 stages to what happens with AI. Number one, and this has already happened, were the chip makers, right? Like NVIDIA, a name you may have heard. NVIDIA was not well known a number of years ago, but now, at least as of the end of last month, worth $4.5 trillion as a company. The value of NVIDIA, which is a chip maker, and they make the best chips for AI processors. The value of NVIDIA is the largest company in the world, and it's bigger than every other country's stock market in the world other than the US. So they just passed Japan, who was number 2. Okay. So that's how big NVIDIA is. And so they provided that first tranche of what happened in AI, which was chips. Okay. They're not the only ones, right? There are South Korean chip makers. There's a Taiwanese chip maker that's enormous. There's a Dutch company that provides the manufacturing capability for chip makers that's grown to be enormous in size. So this notion of AI, commanding the US stock market is true, but it's also a non-US element. And emerging markets, China in particular, but also Korea and also Taiwan, have actually outperformed the US this year because they also have large AI technology companies. Okay. So this may not be an area where the US is the only country that wins, if it wins. And there are concerns, right? We've heard more about concerns, I think, over the last month, which are, reminding people of what happened in the year 2000. If you recall, there were large telecom and media companies, but especially telecom companies that were laying fiber optic cable. And there was a huge expansion in that, much like there's been a huge expansion in AI. And so there are people who are concerned about this. And increasingly, investors are concerned that maybe there's an overextension in AI. And some of the concerns are basically, I'll just point to 2 things. This is an illustration that Bloomberg News put out that sort of went viral on the internet. But let's look at a couple different things. So OpenAI, which is an AI provider, they're the ones who came out with ChatGPT, which was the first chatbot that came out in early 2023. They recently made a deal with Oracle, which has provided cloud computing services for basically 40 years, but now is being repurposed a little more toward AI. They made a deal with Oracle basically to provide or to purchase from Oracle $300 billion in essence, data center and cloud capacity. Okay. What's the revenue of OpenAI? For the last 12 months, OpenAI has had $8 billion in revenue, but they just made a contract, okay, with Oracle for the next 10 years to purchase $300 billion of cloud computing services. Okay, is that really going to happen? That's one part of this consideration. Another question is sort of vendor financing. So NVIDIA sells chips to like all of these companies, okay, for AI processing in the computers. And NVIDIA, for instance, has a deal with CoreWeave, which is a company that didn't even exist until 3 years ago. And they're providing financing for CoreWeave to buy chips from NVIDIA, okay? This is actually, so it seems circular in a way, okay? And so if there's enough demand for AI and if AI works, okay, if eventually it results in sort of positive use cases. So, you heard from the CEO of State Farm last time, right, for this meeting. And State Farm has AI initiatives. Most financial companies do for security. Most insurance companies do for underwriting and things like that. But there has to be enough demand to make this make sense, right? For now, it's enough for speculation for the prices to move up because of all these deals that are being made. And to some extent, it's affecting the accounting and the ability of companies to declare earnings and such. I mean, Oracle, after that deal with OpenAI, the stock price rose 37% in one day when that was announced, okay? So that's opening the door for speculation, and there will be winners and maybe some losers. Eventually, the infrastructure will be built, and we'll talk about limits on the infrastructure in a second. And then eventually, hopefully, there will be companies who make money using AI and don't just necessarily lay off workers because of AI, which we can talk about in the Q&A if you're interested, which is a downward issue for the labor market. Eventually, hopefully, the whole economy will have a productivity gain, and we'll see if that's possible. China, for instance, seems to be more directed at those stages and less on the infrastructure. They're more interested in adoption than infrastructure. But for now, this is happening, and there's a lot of promise, but it has to be met with the reality. And no one's really quite sure if there is that reality. I'll just close by saying on that, Larry Page, who co-founded Google, was quoted recently as saying, "I don't care if we go bankrupt, we can't lose this AI race." Okay. So that sounds a little reckless. I don't think necessarily, it seems almost impossible that Google could go bankrupt, but the large tech companies and these entrepreneurs have been very successful, and they're not foolish, and they think it's a very big deal, okay? So there's been a ramp up, but we don't know exactly who's going to win or lose or if it will eventually be successful. So there's been a big ramp up in announcements for capacity and data center capacity. We have actually at Busey, we have a handful of our clients who've sold property, mostly from farms, that have become or are going to become data centers, mostly in suburban Chicago and Indiana and Northwest Indiana. So there is a bit of a building boom going on, and there's more promise than reality. But what's the problem with that? What do you need for a data center? What resources? Sorry? Yeah, you need electricity. You need a lot of it, okay? And there's a reason why they talk about capacity in data centers, not by numbers of machines or other types of metrics. They talk about gigawatts, right, of capacity. So you need electricity. The problem is that there's not a whole lot of extra electricity to be had. And it takes 5 to 7 years to build from scratch a power plant. Okay? Here in Illinois, we actually were tearing down coal power plants over the last 5 to 10 years and building natural gas plants, right? Which is part of the investment rationale for some of what's happening in AI in a second. So you need electricity. And so as a result, electricity prices have gone up nationally. This is price per kilowatt hour of electricity nationally, and then in Illinois, which is noisier, but about the same. Okay? So, and again, this has electoral consequences. Elections in New Jersey and Virginia were deeply affected by this, okay, and electricity price movements. So, this is going to have to be managed. What else do you need to run a data center? Electricity, but also what? I'm sorry? You need water. You need water for cooling, just like in any industrial process, okay? And the water needs are significant. Now, we happen to, in the Great Lakes region, have plenty of fresh water, but there's some question for some other places like China, who is expanding in AI. They can build power capacity and are doing so rapidly, but they don't have access to water, which is an issue, okay? So these resource constraints, one thing we say in the investment business is that trees don't grow to the sky, right? They need water and they need sunlight, okay? And there are limits. So we'll see what the limits are for the rapid expansion of AI infrastructure, and electricity and water are the two biggest. And when you think about other competing technologies like cryptocurrency and electric vehicles, right? These all consume electricity significantly. And already there have been companies that have switched their business model from mining Bitcoin using electricity because they have electricity capacity. There are companies now that are switching over to providing AI cloud center, okay? So this is big, it's real big, and it's going to be meaningful in the economy and in the stock market. Hopefully, eventually, this results in productivity gains, like, say, what happened in the late 60s with electronics and logistics, partly the building out of the interstate system, but also logistics and shipping and container shipping got its start at this point. In the 80s, there were a number of improvements business improvements in the wake of the recession of the early 1980s. The internet was introduced in 1995 and kicked off an increase in productivity. So we may be looking at another productivity wave that can help grow the economy and perhaps contain inflation. Okay, so we'll see. Like I said, China has an industrial policy around AI that's more about productivity enhancements and using AI for demand and growth. We'll see if we can figure that out as much, but at this point, it's a question mark, which is why I have that there. Anybody want to talk about or ask about anything about AI before we move on? Sure. Sure. The question was, someone has to program all of this stuff for AI, right? We talk a lot about the hardware because that's visible and it's being seen. A lot of the growth in sort of the third wave, after the first one being chips, the second being infrastructure like data centers, the third wave is software, okay, to run this stuff. A lot of companies, so McKinsey just put out a report, take that for what you will, that roughly 2/3 of companies have done next to nothing on AI, okay? They have pilot programs, so which means they bought a chatbot or something, right? And so I just bought a car and I went into the dealership and I had negotiated the price in advance over the internet with Jared, okay? And I go in, I'm like, I'm here to buy my car. I've been talking to Jared. I have an appointment at 10:30, right? And it's funny, they go in the back and then they bring me someone else. They bring me Shane, okay? And that's fine. And I say to Shane, I'm saying, does Jared exist, right? And he said, he works only on the internet. It's like, okay, so he doesn't exist, right? But chatbots aren't really what we're talking about in terms of like making productivity greater. So there's an open question about that. But you're right that the third wave is software mostly, okay? Which is how to work with AI to solve problems. And my father mocks that relentlessly. My dad is 90. He worked in the chemical business, which is about as old school as it gets. And he's at a loss with all this technology, right? Because he's like, I don't even know what to invest in because I don't understand any of it, right? And I spend about 1/3 of my day trying to keep up with all these developments. So it's kind of a big deal. But you're right, software is the third wave. And then economy-wide productivity growth is the fourth wave, if it works. Yes. So there's a question, the question was about, there's been development in chips and wafer technology that perhaps is less energy consuming. And yes, that's true. From time to time, there are software developments. So that, for instance, out of China, there was a research paper that claimed that they could get 44% less electricity generation from their AI software, okay? And from their bot, in essence, right? Because it had more efficient code. And this was just about a week ago. And yes, there have been developments in some chip technology that could be less energy consuming. So it doesn't necessarily mean we need all of the gigawatts, right? There can be some efficiency gains along the way, but it's not exactly like Moore's law, right? I mean, people are often fond of saying like, oh, well, just, wait a while and everything will be half and it'll be half as consuming. It's like, okay, that works for chip output and ability of chips to work, but it doesn't work for everything. And so, yeah, there'll be some efficiency gains, but we'll see how powerful those are. Yeah. Anything else? Yes. Yes. So the question was, how is Amazon involved as a hyperscaler? It's almost all Amazon Web Services. In fact, it is all Amazon Web Services. So I mean, Amazon Retail is a large employer, but it's not necessarily a big mover of the bottom line. Amazon Web Services is really the computer company. Sorry. Well, we might as well take a look at the labor market. Okay. Everything in the labor market looks like this. Okay. This is payrolls in the United States, monthly change in payrolls, right? The actual monthly changes are in gray. The 3-month moving average, which is what most economists look at, is in blue. This has been delayed, and so we don't have updated data because of the government shutdown, but eventually it'll come through. And post-COVID, we've had a deceleration in the labor market, right? The 13,000 layoffs, in essence, at Amazon were of people at Amazon corporate, right? Basically people involved in administration and management at AWS, and they were in essence replaced by AI, okay? And that's the plan going forward. I have some client relationships at Busey, mostly I get doctors, engineers, business owners, people kind of want to know how the sausage is made. And one of my clients is in Austin, Texas. He worked for a long time for Meta, but he works for another tech company now. And he said that, and it's everything you hear about and read about in the newspaper about kids coming out of college with STEM degrees not being able to get entry-level employment. He said the employment market for seasoned people in technology is extremely hot, but for everyone at the entry level, it's extremely cold, and that's all AI. And he's been talking about that for 2 years. So that's not necessarily new, but it's definitely being covered. So yes, what's happening at Amazon with regard to labor market reductions is AI related, and a lot of people are concerned about that, right? With regard to their job, and I'm no different, right? Right? I mean, like I'm trying to stay ahead of AI just like anybody. Okay. So maybe next year you'll have an AI bot who's presenting to you. I don't know. We'll see how that goes. Okay. I don't want to take too much time, but just quickly, yes. Well, so the question is, what about downstate Illinois, I guess south of I-80 and outside of Chicagoland? So I live in Chicago, but my family has a farm in Kankakee County. And, my parents are originally from there. And, I went to U of I, so, and it's nice to work for Busey because I can drive all over the fruited plain in Illinois. It's good. We have some advantages in downstate Illinois. So I'm going to be talking in Grundy County in a few weeks to a group of people about their challenges, but they have significant nuclear generating capacity, okay? That's a possibility for Illinois. Illinois actually produces more nuclear electricity than any other state in the union, okay? And that's largely because of the efforts it's partly because nuclear power was kind of invented here, okay, in Chicago, at the University of Chicago. But also because like my grandfather back in the day was building nuclear reactors, okay, after the war. He worked for Chicago Bridge and Iron. So the familiarity with and the reliance on nuclear power is helpful and could be potentially helpful for downstate Illinois. The existence and availability of water in aquifers is helpful. But I mean, we already have usage of electricity in the state that is significant. And as I mentioned, the electricity prices continue to rise. So that's an issue, I think, for everyone in the state. But the familiarity with and the ability to expand electricity generation is interesting, okay? So even though population is declining, I think Champaign County is the only county south of I-80 that's growing in population. That can unlock additional resources for electricity that might not be available otherwise. So the electricity generation in Illinois, for instance, is more than half nuclear, okay? It's a third so-called fossil fuel split evenly now between coal and natural gas. It was almost all coal a number of years ago, but we've torn down some of the coal plants and built natural gas generation. And so natural gas is a great opportunity for investors, okay? There are a lot of different ways to play natural gas, but natural gas is the favored fuel that can power AI and can power households if there are other forms of electricity that aren't necessarily as attractive. Wind is responsible for about 13%, and solar is just 3% of the total at the moment. So I would expect solar to continue to be de-emphasized, especially if subsidies are reduced. I don't know if that'll happen or not, but if subsidies are reduced, then you'll see less use of farmland for solar. But grain prices being what they are, especially for corn, that hasn't been helpful, right? So that's lowered the bar a little bit for some of those changes. But we've looked at it on our own property. We only have 200 acres, but we've looked at wind and we've looked at solar, and we don't necessarily see the benefit, and we don't want to lose control. And I think there are a lot of people who probably feel that way. Okay, all right. So I wanted to be responsive and good about answering questions, but I don't want to go too long without talking about some other things. So the labor market is decelerating. That's a weaker part of the economy. People are concerned about AI stealing their jobs, and that's reasonable. Okay, I think it's reasonable for a lot of people to be concerned about that. And it may eventually significantly affect consumer behavior, especially if these layoffs mount. But for the time being, what we've had in the economy is less supply of labor and less demand for labor. This is the demand picture. The supply picture is reduced partly because of immigration, partly because of a slowing birth rate, partly for other reasons too. So because there are some people leaving the workforce who are 55 plus and not returning, okay? Either because they're wealthy or because they're done. So the job market is currently sort of in an equilibrium. Unemployment is still pretty low at like 4.3%. And that's true here in Illinois as well. It's a little higher than nationally because supply of labor and demand of labor are both relatively low. So we're in a job market where people are happy to keep the job they have because they're not sure exactly what could be next, but it's a low hire and low fire type environment. Okay. And that's where the labor market is. With regard to investment markets building off of this, so the stock market is richly valued. Okay, I think we know this. And this is an issue that obviously includes AI, and that's the number one concern about the current stock market and AI, which is large companies are driving these valuations, and we're now getting back to pre-COVID valuations. This is basically the line chart here is the forward-looking next 12 months of earnings, price divided by the next 12 months of earnings. And so that's now at roughly about 23, which is close to what it was in the year 2000. But there are some differences. I mean, the biggest difference versus the year 2000 is that these companies are very profitable, okay? The low profit companies actually are smaller companies, not the big ones, not the hyperscalers we were talking about and the big names tech names that everybody knows. 9 out of the top 10 companies in size in the US are technology companies. And so those tech companies have elevated valuations, the green line, and the rest of the stock market is actually pretty typical, maybe a little rich. So if you take out the biggest tech companies, the top 10 companies out of the S&P 500, that's this darker line here in between the green line and the blue line, those valuations are much more modest, roughly about 20 times earnings, which is not great, but not terrible. And as long as earnings can continue, okay, there's someone in the investment markets who refers to earnings as the mother's milk of stocks. So the growth rate of earnings in the United States is about 12% per year right now. And that's very strong. And so if that can continue, then these valuations can be justified. They've been earned by companies that have delivered a lot of earnings. Okay? That's very different from the year 2000 when a lot of this was on the come. Okay? But I'm not going to necessarily work too hard to rationalize it. There is some danger in that the top 10 stocks are now a higher concentration of the stock market than ever before. And this is also true, as I mentioned, in some select economies around the world, especially in Asia, in emerging markets. Now, valuations in the US are pretty elevated. Those are the purple diamonds here. The bars, the gray bars, represent the range of valuations historically. And so you'll note that US companies versus other companies in the world, US, Japan, Eurozone, emerging markets, and China, those other markets are cheaper. Okay. But the unfortunate thing is that until this year, the performance of non-US markets has not been particularly strong. Okay. The US market is about two-thirds of the global market, and roughly about half of the US market is technology companies. Okay. So that concentration is higher growth, but it could be sort of boom and bust. So other countries have cheaper valuations, Their earnings grow more slowly. They have less technology. They've been less profitable, but they are also, to some extent, safer. Maybe in some emerging markets in China, that doesn't necessarily apply to, but it certainly applies to Eurozone, and it does apply generally to Japan, at least in the current circumstance. So we do still have some non-US investments. We're not getting too crazy about it, but those are attractive on valuation. And this year that has rewarded investors. What's also cheap, and we talked about this a year ago, value companies are at the typical discount of valuation, below their typical discounts of valuation to growth. So typically, and growth companies should have more aggressive valuations because they grow faster and they've earned it. But value companies typically are at about a 30% valuation discount. They're now at about 40 to 50. So they're attractive, but again, it's hard to expose yourself too much to value because growth has done so well and because the AI trade is so powerful for growth. By size, mid-sized companies are more attractive in valuation and have the same earnings growth expectations in markets and have generated the same earnings growth in the past. So we have a little bit more exposed to mid-sized companies than larger companies, but we're doing everything we can to hold as much as we can justify of the large tech companies because they are driving so much value. Small companies are now 25 times earnings, and they also have roughly about 40% of smaller companies are unprofitable. And so I'm more skeptical on small than just about anybody at our shop. The only reason that small companies could perform reasonably well in the near term is because the Fed's cutting interest rates. And interest rate cuts are like the schoolhouse burning down for the students who have bad report cards, okay? If you get cheaper financing, if you don't have earnings, you can do better, okay? If you get cheaper financing and lower short-term interest rates can do that for smaller companies. So we know what's cheap, right? I mean, value is cheap. Non-US markets are cheaper. There can be some advantages elsewhere in the US stock market, mostly in mid-sized companies. But as long as the larger big tech companies generate earnings, and as long as AI continues to move forward in a way that looks like there's going to be demand and economy-wide adoption, it's hard to see large failing in the near term. And so there could be some volatility with the richness, but the stock market overall still is a good place to put money. And I've just talked my way through that. These are mortgage rates. And last year, mortgage rates were about 1% higher than they are now. So they've fallen to some extent since we last met, and they've fallen considerably since late 2023. And that's largely because 10-year yields have declined to some extent, and the Fed is cutting short-term interest rates, okay? 6.28% 30-year fixed rate mortgage is not what it was. It was 3%, okay? And last year, someone asked, are we ever going to see 3% again? And I said, without a super hard recession, no, probably not in my career. I've got 12 years left, right? So I don't think we're going to see that level of cheapness, but the lower that mortgages get, the more likely it is that people who have a low mortgage on their existing property will look to sell and put their home in inventory. And that's inventory has been frozen for a while, which has kept housing unaffordable and made it more unaffordable. So prices could start to come down meaningfully for younger purchasers if those mortgage rates continue to fall, both because the financing is cheaper and it can unlock some inventory in the housing market. So I think this is a good thing, but again, 628 is not cheap. If you're going to take risk, I would take risk in equities. Don't take risk in credit, okay? The one exception to that would be catastrophe bonds, which we talked about last year in the Q&A, which is still attractive, but not as attractive as it was. Basically, the extra yield you get for senior loans in public markets, or what used to be known as junk bonds, high yield corporates, or emerging market debt, those extra yields you get, called a spread over treasuries, are now at record lows, okay? We're back to like 2006-07 in terms of the extra compensation in credit. So and part of this is because of all the private debt that's been launched and issued for data center construction and other things that has helped to compress those spreads. So I wouldn't take risk in fixed income. If you're going to take risk in the equity market, and treasuries can still get you a decent yield with some risk. Maybe it's not risk-free, but like I put it here in this chart, but still a decent opportunity. Lastly, I'll just make a couple comments on gold. Gold is extremely frustrating. as an investor because, Warren Buffett said it pretty well. He's like, people dig gold up out of the ground, refine it, put it back in the ground, and it gains value. How does that happen? Gold doesn't have a yield, right? It doesn't have earnings. It doesn't have a coupon. And so historically, gold became available to invest in again in 1975 legally by people. It was taken off fixed pricing in 1972, but individuals couldn't buy it. And since then, the stock market has gone up pretty considerably, about 400x. The bond market has done pretty well, and gold has kept even with the bond market over time. But the most important thing about gold is that there are these episodic rises, okay, that often happen for very different reasons. It's not the same reasons that drive the gold market. And it's interrupted by long periods, 20 years from 1980 to 2000 and 10 years from 2010 to 2020, where you lose value or you're flat. So you have to be patient if you want to invest in gold. It can be a hedge for risk, kinds of risk that aren't hedged necessarily in markets. The reason that gold has risen lately is what we call the debasement trade, which is basically people concerned that the US Treasury may not pay its obligations, and that almost every other country in the world that has a major currency is spending more than it's taking in. Okay, so the only country in the world that isn't profligate basically is Switzerland, and that's a country of 9 million people. Okay, so that's not really, doesn't have a lot of ballast. So that's what's driving this recent run up. And so in that sense, it could continue. But you have to be patient because there can be long periods where gold doesn't compensate you. Most of our portfolio, and in fact, all of our portfolios include stocks and bonds and other things that are not gold because we want more of the blue line to generate wealth over time, and the gray line to some extent, and not as much necessarily of that yellow line. But there are reasons that gold is useful. And in the current environment, this debasement trade could continue. So that's just a quick comment about gold. And, for the last 20 years, gold's performance has been 11.4%, equal to the stock market. I mean, that's a little cherry picking, but that just tells you what's happened basically since the year 2000 has been an environment in which gold has become more valuable. Okay. So I just wanted to have some comments on that because we get a lot of questions on that from clients. So in essence, I think it's reasonable to expect the economy can continue to grow because of consumers and because of AI. I think, we didn't really talk that much about inflation, so we can if in the time we have left, if you wish. But we're really closing in on inflation at 3% and staying at 3% for quite some time. The Fed's target of 2 probably will be abandoned at some point, in my view. And already I think markets are coming to that conclusion, but we'll see. AI can change that if it raises productivity. Employment is soft and that with housing are the weakest parts of the economy. But as long as consumers spend, and especially the top end of consumers can spend, and as long as we have a labor market that is in equilibrium with an unemployment rate of 4 to 4.5%, the economy can continue to chug forward and generate maybe 2 to 3% growth, which would be reasonable. Stock market's overvalued, but there are opportunities away from the largest tech companies, but those are still an engine of growth, and you avoid them at your peril. Take risk in stocks, not credit. Treasury bonds and other lower risk bonds have reasonable yields finally. And then I would not discourage people from holding gold, but we do not use gold in our portfolios for the reasons I mentioned. Okay, that's my summary. Yes. So the question was, do you think that the government will continue to reduce interest rates, which may help to bring mortgage rates down? The main driver of mortgage rates is longer-term bond yields, which the government does not control, okay? But short-term rates here in this chunky line certainly influence longer-term yields to some extent. And the fact that, the big rise in gold, the really strong rise in gold happened after mid-August when the Fed chair Powell announced that he was open to cutting interest rates in the fall at Jackson Hole, and that just kicked off essentially a massive gold rally. So yes, that's likely to continue. Financial markets think that we can get as many as 4 more cuts down to 3%. The current rate is 3.75 to 4. So that's the expectation. But when the Fed chair said at the most recent meeting and press conference that December cut wasn't a done deal, markets lost confidence. So there's nothing that the stock market likes more than interest rate cuts. And that's enough to keep supporting the stock market, even beyond the fundamentals from technology that are generating earnings. Okay. Thanks for your question. Yes. So 2 quick questions. One was, what really is crypto and Bitcoin? And we could do a lot of time on that. I would just say, and then the second question was, what about 50-year mortgage? I'll just take the second one first because that's quick. I just think the president is spitballing, right? And he's coming up with ideas. That's already been knocked down by some people because, I had a mortgage once. I paid it down and then I was done with it. I got a 15-year, not a 30, because if you get a 30, right, fixed rate, you're paying a lot more of your payment is interest, okay? So with a 50, a lot more of your payment is interest. So that's sort of a caveat, but I think he's just spitballing and trying to get sort of ideas out there to see what we can do, okay? That would bring the price of the mortgage down, but again, it's not the healthiest thing for people if the rate is high enough, because then you're paying a lot of interest. With regard to crypto, so cryptocurrency is an alternative currency that it's a private sector currency. It's not backed by anything, okay? It's a medium of exchange, like any currency, that can be, it's not really used, it's more used for speculation by investors than it is actually used to pay for things, okay? Like 10 years ago, cryptocurrency was used mostly by criminals, okay? So the people who, like hackers and organized crime, transacted a lot in crypto because it was not easily traceable and usable for their purposes. So it's not used widely as a currency, but it's an alternative to so-called fiat currencies like the US dollar. The US dollar is valuable because the US government promises to pay its debts, which it has always done. And the US government is funded by taxes, right, from households and businesses, and that's very valuable, okay? Crypto is a private currency that isn't backed by any government. So there's no taxing authority. There's nothing that can increase confidence. It's simply the confidence in cryptocurrencies like Bitcoin is in their use, right? And if other people use them and value them. It's not too different from gold, right? In the sense that gold isn't backed by anything. It's backed by, it's essentially backed by thousands of years of people liking gold, okay? And it has some value in that well, I won't go into that, but crypto is dangerous in the sense that when I said about gold, yeah, worst case, maybe you don't lose much money for long periods of time, but you have to be patient, right? With crypto, you could lose everything. The crypto, so who stores that? We can talk a little bit about more of this a little bit later, but it's stored digitally and traced digitally through its manufacturing process. But again, none of this is really strongly regulated, right? And if you think about the US dollar eventually or originally being backed by gold and then being backed by the full faith and credit of the US government, which is still worth something, right? Crypto could be worth zero. But when all the other currencies in the world except the Swiss franc have lost value against gold since 1975, right? And the purchasing power of the US dollar is 1/20th of what it was in 1975 because of inflation. Maybe people should be free to hold their assets in a currency like Bitcoin if they choose and not have their purchasing power eroded over time by a profligate government and a central bank that doesn't really care about them. Okay, so you can buy crypto. Yes, you can buy crypto with dollars. Crypto costs dollar money, okay? Like any currency, you can exchange it for dollars. right? But as I've said, it's mostly been used by investors for speculation. It's not really used widely as a currency. You can't use it on the street, okay? And it, again, it's tracked and valued digitally. So, all right. Okay. Now there was a pre-submitted question about donor advised funds. So if any of you are interested in donor advised funds, donor advised funds allows you to make a donation and take a tax benefit, a write-off in the year in which you make the donation. But the money can appreciate in an investment fund, a donor advised fund, over a period of time. And you can still have some control over it, as opposed to making a donation to a charitable endeavor that you then lose in the year in which it's made. So you can promise to donate in the future. You can send your money to a donor advised fund that can grow over time, just like any other investment fund. But there are issues. One is that you do lose some control. It's irrevocable. So, and you can only suggest donations that it can be used for. But there are large investment companies like Vanguard and Schwab and Fidelity that have donor advised fund capabilities, and there are charities that do as well. There also can be some higher fees, which is another negative, but it's flexible. So if you had, say, $500,000 that you wanted to contribute to charity, you could do it this year and take the tax benefit this year, if that's what you wanted to do, and then spread the donations over time in the future. Okay, that's the flexibility that it really offers. And it is, again, it can lead to some tax liability deductions. Also, it can handle complex assets beyond just stocks and bonds. There are a lot of other assets that donor advised funds can take. And we have a lot of clients who have a lot of embedded capital gains, right, from long held investments that are appreciated. And so, it's part of that menu of things you can do when you have appreciated assets. All right. So one person has already left, and appropriately so. So I don't want to keep you guys too long. Are there any last questions? All right, I'll hang around afterward if you want to talk about something one-on-one, especially like cryptocurrency. Okay, thanks a lot. Appreciate it.
I do have a couple of quick announcements to share. First of all, State Farm is partnering with the Salvation Army to help make this holiday season brighter for families, children, and seniors who lack resources to give or receive gifts during the holidays. And they are inviting retirees to participate. They should be providing us with information on how we can do that next week. And then we will have it in our newsletter and on our website. So if you're interested, keep your eyes open for that. The other thing is very exciting. We have the Bison hockey team here in town. And in January, Busey is giving us the opportunity to attend a game. So we will have more information about that as it gets closer to the game, again, in our newsletter and on the website. And today is our last quarterly meeting. I hope you've enjoyed the presentations that we've had this year. We look forward to another great year. Please have a happy holiday season and a safe winter. Thank you very much.